Investors, much to the chagrin of perma stock market bears, the old normal keeps playing out in 2023, almost to the week and almost to the day. It looks like the bottom and upturn to the fourth quarter rally came right on cue. The markets look to have made a low on Friday, October 27th, at the end of institutional tax positioning, at the end of the final full week in October. The Oak Harvest investment team had discussed this likely dynamic for months, all the way back in June and July, and its likely outcome for the markets turning back higher in very late October and early November. Folks, most everyone on financial TV says we don't have a crystal ball, and then goes on to give their opinion predicting what the future might hold for the markets, sectors, or individual stocks. Investors, by definition, that's the meaning of behind having a crystal ball. However, nowhere in the definition does it say that predictions seen when looking into a crystal ball will be accurate, particularly when it comes to the financial markets. We do our best with limited information, making decisions based on our experience and knowledge, serving our clients in the best manner we can. The future is always hazy and uncertain. 2 weeks ago, the title for the Stock Talk was, "It's make or break time." And last week, we followed it up with, "Is it really different this time?" I put the links to those two videos in the description below in case you missed them. This week, I'm repurposing and updating some of the content and real-time data we watch and we've shared with you over the last 4 months during the summer correction in the stock markets. For fun, I'm titling this one, "Santa Has a Calendar, and He's Got a Bloomberg Too." Please take a moment to click on both the subscribe and notification bells so you'll be notified when our investment team uploads our latest content. Okay, investors, the S&P 500 traded down and to the right in a very normal seasonal fashion since the mid-July 4,600 peak. Here's a chart of the S&P 500 since last October 2022 when we made our lows. Investors, the overall market has gone nowhere since mid-June of this year and closed slightly lower than the 200-day moving average a week ago. And of course, that's when the dire 1987 crash calls came out of the woodwork, even though year-to-date, the S&P 500 looks nothing like it did in 1987. While many of those calls were being put out in force by a host of financial TV personalities, the Oak Harvest investment team was messaging it was finally a favorable environment for the market to finally turn up. Why? For many of the same reasons we've discussed over 4 months ago in advance of this correction and throughout the summer pullback. First, the end of October comes with it what has historically been the sweet spot of the seasonal calendar for the fourth quarter rally during the third year of a presidential cycle. I've had those dates circled on my calendar since October of 2022. Yes, for over a year. Investors, historically, the Santa Claus rally that many in the financial press talk of doesn't start in mid-December. I repeat, historically, it doesn't start in mid-December. It starts at the end of October. Investors, Santa Claus, unlike many shoppers who can now use Amazon for next day delivery, Santa Claus shops early. We've covered the monthly seasonal returns for the S&P 500 many times over the years, but once again, here are the daily, yes, daily, average return since 1945 from Merrill Lynch. Okay, so if you break out your reading glasses and look closely enough at this table, what you'll find is amazing. It's October 26th and October 27th, the same days as 2 weeks ago, are historically the end of the summer sell-off, not the beginning of a market crash. Of course, history doesn't always repeat, and past performance is no guarantee of future result. But so far, so good for 2023 and the beginning of a fourth quarter Santa Claus rally. Hence, the first part of this week's title, Santa Has a Calendar. So now not looking at historic data, but rather looking at 2 real-time data series that we've discussed early and more often than most advisors, which have proven early to tops and bottoms in the market the last few years, we find reasons to support our ongoing fourth quarter stock market rally call. The first is a chart of real interest rates that about 2 weeks ago, right near their peak, many other financial commentators on TV, after ignoring them for almost 18 months, finally discovered their significance. For trading and short-term indicator purposes, I've been watching the 1-year and 2-year real interest rates, and those both broke their uptrends the week of October 13th. For this video, I'm going to focus on longer-term maturity of the 10-year real interest rate, which many other advisors have been quoting as key. You'll see on the Bloomberg chart below, the steep uptrend since July has been broken. That's a great thing. You'll also see from the chart below from the technician Rob Slimer at RBC Wealth, the momentum indicators like the RSI have peaked and rolled over for real interest rates. Like when? Yes, like October 2022 lows in the markets. And that's an incredibly good thing. I've discussed the importance of real interest rates to stock PEs in the markets for over a year now. Investors, this cycle, A peak and trend change in real interest rates has been an early indicator of good things to come. Similar prior peaks included Christmas of 2018, the COVID 2020 lows, and most recently, the October 2022 stock market lows. Investors, this is the first strong indicator Santa Claus has a Bloomberg too, and seems to be a chartist at heart. The second and final real-time data series I want to discuss is the dollar. For this cycle, dollar weakness has been good and dollar strength has been bad for stocks. Why? Because the dollar strength hurts U.S. large cap stocks' earnings as they have heavy revenue exposure overseas. Dollar strength marginally hurts the S&P 500 revenue and earnings growth rates, while dollar weakness helps both. Here's a chart of the broad dollar index most investors look at. That's the DXY index. If you overlay a chart of the S&P 500 on the chart of the DXY index, you would see that rallies and sell-offs in the S&P 500 would coincide in an inverse way with rallies and sell-offs in the DXY index. While the stock market was selling off at the end of the week of October 20th, few TV commentators were looking at these two real-time data series. Both real-time data series implied that stock markets would be bottoming shortly in their very normal seasonal way. And given the stock market's reaction and strong rally up the week of October 30th, once again, I have to say, Santa has a Bloomberg and is a better chartist than many others in the world of finance. As for a template of what a continuation of the old normal might look like for the remainder of the fourth quarter of 2023 and the first quarter of 2024, I've updated a chart I've referenced for about a year, comparing the final 2 years of the internet build-out in 1998 through 2000 to the current AI cycle build-out land grab that started in October of 2022. To the date, the market's move in asset classes has been eerily similar almost to the day and week. I challenge you to explore this topic and analogy of time periods more on your own research. For now, it remains the Oak Harvest investment team's opinion that no, the summer sell-off that we forecasted from July was not different this time, and the seasonal Santa Claus rally starting late October and lasting into late December and potentially extending into a very volatile manner into mid-March of 2024 will not be either. We're here to help you on your financial journey into and through your retirement years. For myself and the whole team here at Oak Harvest, have a blessed weekend.